Tough morning for Asia. A bit of a correction is underway in India in any case, and the last couple of days of earnings. Today's futures and options expiry. Heavy news day. Puneet Nanda, CIO of ICICI Prudential Life Insurance Company, is with us with his perspective. Puneet, morning. Good to see you again. We've been noting that the last couple of days insurance companies have started deploying cash, and just as well, you've been doing that, using this fall as an opportunity?
Rather than speaking about last couple of days, as you know, insurance companies tend to take much longer calls on the market. The sharp rally that we've seen over the last couple of months, in fact last 3 or 4 months, has been largely due to two factors. One is, of course, tremendous liquidity globally being available, which has obviously led to greater risk appetite. And the second is the hope of economic recovery. Now, of course, over the last few days, what we are seeing is that there is some correction, because at some stage, people will want to take profit, and also at some stage, people will want to see real data on whether economic recovery is happening or not. As far as insurance companies are concerned, we do tend to take longer calls rather than pure liquidity-based calls. On the margin, if I see, most of the macro data is positive compared to where we were, let's say, 6 months back. So to that extent, clearly it does make sense to invest for long-term investors. Of course, the liquidity-driven rally would have led to some sectors or some stocks perhaps looking a bit richly valued. As things come within our comfort zone in terms of valuation, we will keep on investing.
Puneet, morning. The first meaningful knock to our market actually came on policy day. How worried are you about the rate tightening now having begun, and how would you approach some of these rate sensitives?
The fact that RBI would start this, the exit policy on the monetary side was well known. So I do not think that has caught anybody by surprise. So if anything, the direct actions, they have still resisted. So they've started some of the things which, perhaps were no longer relevant. So for example, liquidity support to some non-banking sectors, those kind of things. And also perhaps they've started doing some things which do not have very significant immediate impact. So for example, SLR or those kind of things. So I don't see anything being a surprise in the monetary policy as such. The second factor is, as far as interest rates are concerned, again, I would say the fact that interest rates have to tick up in the medium term is also largely was expected and is known. So from my perspective, I think it's only a question of timing and sequencing of events that one needs to worry about. I think over the next year or so, interest rates will tick up marginally. It will perhaps be preceded by RBI trying to tighten the domestic liquidity. They've given enough indications to that effect. But the most heartening feature for me is that RBI is completely focused on the growth paradigm of the country, and not just RBI, I think the policy makers in general. I think they've done an admirable job over the last 1 year or so on this front. And as long as they're able to maintain that balance, I think things will be okay.
How much investable cash do you have at this point, Puneet, yourself, and between the industry, the insurance sector, how much investable cash do you think is lying to come into equities?
It's a very tough question, Udyan, because I don't have the answer. But I'll tell you that over the entire financial year 08-09, the life insurance sector invested somewhere between 50 to 60,000 crore into equity on a net basis. For the first half this year, the net investment has been relatively muted, somewhere around 13 to 14,000 crore. I expect that for the full year, the net investment this year will turn out to be more than last year. So on that basis, it is fair to assume that there will be a significant investment in equities by Indian insurance companies in the second half of the year.
Even a ballpark figure, Puneet, of what that figure could stand at?
I told you, last year something like 55,000 crore. This year, so far, let's say somewhere around 13 to 15,000 crore. So look at the difference between the two. You'll get the number. In fact, I expect to exceed that number.
Okay.
So 40 to 50,000 crores even in the next 5 months?
I would not rule it out with them. Also, let us remember that retail risk appetite comes off slowly, also comes back slowly. Last year, it took a while for retail risk appetite to come off. Similarly, this year, retail risk appetite is only gradually returning now. So I think a combination of the fact that second half anyway tends to be very strong for insurance for a number of reasons, and the fact that retail risk appetite is returning, albeit gradually, will result in the kind of numbers that we are talking about.
Mithali, just to put that number in perspective, if it's 47,000 crores in the next 5 months, you're talking $10 billion over the next 5 months, an average of $2 billion a month from insurance companies. That soaks up a lot of their fire supply even if it has to come.
Please welcome. Puneet, any reason though why things have moved in opposite directions for you guys versus the mutual funds? I mean, just this month, you've put in, what, under 5,000 crores and they've pulled out more than 6,000 crores.
I don't know what's happening on the mutual fund side. On the insurance side, clearly the pace of inflows is picking up. More importantly, as markets correct and people feel, including us, a lot of insurance companies feel that valuations are becoming in the striking zone, money will flow in, because at least in life insurance I can say that there is enough liquidity. It's more a question of our view on the markets.
Two big institutional favorites though have disappointed the market, Puneet, telecom and capital goods. How have you approached both those sectors?
On capital goods, my view is that next year will turn out to be much better than what we are seeing now, because the cycle there turns out to be much longer than in a lot of other sectors. So currently we are seeing a lot of investment plans. So if you talk to banks, you will realize that a lot of approvals are falling in place. The sanctions are falling in place, but the actual outflow is not happening. So perhaps a lot of that will fructify in the next year. And broadly, if we feel, and I think there is general consensus that in terms of the way the economy is going, of course we have weathered the storm very well, but next year will definitely be better than this year. So from putting those things together, I am reasonably optimistic on the capital good sector for the next year. What was the other sector? Sorry. Telecom, okay.
Yeah, telecom.
See, on telecom, I think it's a mixed bag for a number of reasons. There are some fundamental factors and there are some technical factors. Price war has kicked in. Frankly, that was perhaps the biggest reason for the sector to underperform. And then there were, of course, a lot of corporate events. Broadly, I think domestic consumption has stood the test of time, and we've seen, especially in this quarter, frankly, if you see the results that have come so far. I'm not talking about telecom specifically, but a lot of domestic consumption sectors, whether it is autos or whether it is some of the on the banking side also, things are actually reasonably in good shape. If anything, I think a lot of concerns on weak monsoon have been mitigated because of these results. So I would say telecom will turn out to be as a sector, perhaps a market performer. Within that, of course, we'll have to see company by company what's happening.
What about